Welcome to the Contrarian Capitalist podcast. I'm delighted to be joined today by Adrian Day, Chairman and CEO of Adrian Day Asset Management. Adrian, how are you?
I'm fine, thank you, Robert, and thank you very much for asking me on.
Really looking forward to this, and I thought a good place to start would be gold, because looking at the weekly gold chart, there's quite a lot of sideways movement. It seems to be in a tight range to me, and I find that quite healthy considering what could potentially happen moving forward. What are your thoughts?
No, I think you're absolutely right. It's healthy. I mean, when you look at what gold has done over the last 3 years, and then in particular what it's done this year, it's gone well above trend this year. So frankly, I'm sort of surprised that we haven't had a meaningful pullback. But so far, every pullback we've had has been very short-lived and quite shallow. Sideways movement, I think, is very helpful, healthy. It's, just allowing the market to consolidate a bit.
It seems to me that people can lose patience quite quickly when a market does this. But if we, and I know we're going to speak about US debt and other things later on, but I look at this and look at the trading range it's in. I find it quite healthy, but also that people sometimes need to see the bigger picture and not just, what's happening on a day-to-day, week-to-week basis.
No, absolutely. It's funny you say that because I find, in particular, gold investors tend to be very impatient. Gold and silver investors, they're always looking for more, and they're never satisfied with what has been. And that's absolutely true. But I think a few things have happened, in the last several weeks. Number one, as I said, we've had this above trend rally, which just makes some buyers say, oh, well, let's stand back and wait a little bit. You've had buying from Asia, and that's both official and non-official, has kind of slowed a little bit. It hasn't gone into reverse. I'm not suggesting that the Chinese are selling their gold or anything, but and certainly the non-official Chinese has slowed in the last several weeks. You've got the CTAs, the commodity traders in the US have been heavily selling and shorting. So, all of those factors together, I think, have contributed to the pause. But when you look at the big picture, the way I look at it is that all of the drivers of gold over the last 3 years, all of the people who've been buying gold and the reasons they've been buying gold, such as central banks buying gold to diversify away from the dollar in the face of dollar weaponization, none of that has changed. And I should just say to people, we in the US, and I'm sure in Britain, you tend to blame the guy in charge for everything.
Hmm.
This didn't start with Trump, and it won't end with Trump. But I think it's fair to say that nothing that's happened this year since the new administration came in has changed that narrative. And you can talk about all of the drivers of gold. The other driver of gold, of course, is people concerned about the fiscal deficit. That hasn't gone away. Again, didn't start with Trump, but it hasn't gone away. So all of these factors are, in my mind, are just going to lead people to continue to want to accumulate gold over the coming, year, 2 years, 3 years. I don't know.
You mentioned the US deficit there. Let's jump into that because I know that a big deal was mentioned about, big beautiful bill, and it's gone past 37 trillion. And I see different people say, well, this isn't sustainable. Some people say, well, with the USA, it's a reserve currency, we can deal with it. Again, what's your perspective on that, Adrian?
Well, certainly when you have a reserve currency, it enables you to print more money, have a greater deficit than you otherwise would be able to do. So if the US didn't have the reserve currency, which means that there's always a ready demand for your currency. But if the US didn't have that, we wouldn't have been able to get where we are without a huge devaluation in the dollar. Um, but that doesn't mean that you can carry on. It doesn't mean there's no limit. And certainly when you start to get to the point where we are now, and I focus a lot on debt service because debt service is what you have to pay, to keep the good faith and credit. You can't postpone that. We're getting to the point where that is going to become almost unsustainable. I mean, right now, the debt service in the US is the largest. It will be this year, it'll be the largest part of the federal government budget. Bigger than defense, bigger than Social Security, bigger than Medicaid. It's the largest single item in the federal government budget. And with rates where they have been, it's a sort of artificially low number that we're paying. If you think that 5 years ago, the government issued 5-year bonds or notes, I should say, 5-year notes, they were issuing them 5 years ago at like 1.5%, 1.75%. And now when those notes mature, they're going to have to renew them at 4.5% to 5.5%. So that debt service is going up dramatically. There's very, very, very few bonds that are maturing this year, next year, that can be renewed at a lower rate. But most of them are being renewed at 2 or 3 times the rate. That means the debt service is going up. And I'm often reminded of, I know Ernest Hemingway is not such a popular writer in Britain. I've never read a single book of his, to be honest, but he's not so popular in Britain as he is in America. But he has a phrase that's well known and kind of hackneyed, but it's how do you go bankrupt? Slowly at first and then suddenly. And, that's how all these things happen. They happen slowly. And, people have been talking about the debt in the US being unsustainable ever since Ronald Reagan. We're talking 40 years. Doesn't mean they were wrong, but these things can go on a long, long time, just slowly getting worse, and people saying, look, it's not a problem. We owe it to ourselves. That's about the most ludicrous statement I've ever heard. It's also not true because we don't owe it to ourselves. Most of our debt is owed to foreign governments. But anyway, even if it were true, it's stupid because I might be the debtor and you might be the creditor. And then suddenly you reach that point where things start to spiral out of control. So we're not there at the moment, but I think unless they start reining in some of the spending and at the same time rates come down significantly, I think we're going to reach that point pretty quickly, frankly.
Well, do you think that those two things are likely to happen, i.e., rates are going to go down and government reins in spending? Because I say the same similar to the UK, where it's easy to sit here and say that's what should happen, and I think most people would agree. But then the reality of that happening might be completely different.
There's simply no appetite in the US among the political class for cutting spending in any meaningful way. I mean, first of all, President Trump, before he came in and his advisors they already said they weren't going to touch entitlements. Well, when entitlements are the problem, entitlements in general are the largest part of the budget. When entitlements in general, and they have grown so dramatically over the years, that is what you have to tackle. And there is simply no willingness to tackle that. And we saw what happened with Britain when there was, as I understand it, a relatively half-hearted attempt to tackle some work benefits, right? And there was a Labour Party revolt and the government backtracked. But unless you tackle that, everything else, Elon Musk, God bless him, we cut, 10 million to some, lesbian theater collective in Connecticut. Okay, great. But all of that stuff is sort of theater. It doesn't really affect a central issue. So, and it's often said that America tries everything everything first until there's a crisis, and then finally they hit on the right solution. It makes me sad and angry, frankly, and frustrated, because when you look at, let's just say, Social Security, which is meant to be an insurance program, right? You're meant to pay in, they're meant to invest it, the government's meant to invest it, and then you get the proceeds when you're an old age. It's different from, what do they call it, national insurance in Britain. This is meant to be an insurance program, but of course it's long since has it ceased to be strictly that. But you know, when Social Security came in 1946, right, the average life expectancy of a male, and it was only males who worked in those days primarily. I mean, a lot of women worked during the war, of course, but the private workforce was primarily men, and the average life expectancy was something like 70 and a half years. And so when Social Security came in, it basically was paying the average person for about a year. Well, now the life expectancy is what, 70, 78, I think? Don't quote me on that, I should know it. I should know it before I talk anyway. But the life expectancy has gone up dramatically. And so a program that was meant to just sort of take care of old people in their old age, but we knew it was a very short period of time, has now, not only has the length of time expanded, but now it's become and I'm not saying good or bad, I will if you want, but I'm not saying good or bad, but it's become but the mandate has expanded. So now sick people who can't work and, all sorts of additional benefits have been added on to Social Security. And so the program's bankrupt. If in 1955, let's say, they'd have said, well, the average life expectancy is increased, we're going to increase the age at which you start receiving by 1 year. Wouldn't have been a political firestorm. And then in 1960, say, well, it's increased again. We'll increase that age by 1 year. You could have saved the system, but nobody is prepared to do anything until it's at a crisis. I'm sorry, I rambled on too much on that. And so cutting rates, as you know, Jerome Powell, the Federal Reserve Chairman, is very resistant to cutting rates at the moment. I think there's two main reasons for that. One is he knows full well that inflation, and we define inflation, I mean, we're not talking about real inflation, which is increasing credit. We're talking about how most people commonly think of inflation, which is an increase in prices, which of course is a result of inflation, not inflation itself. But anyway, he knows full well that inflation is not under control. Yes, it's come down an awful lot from the COVID years, but the CPI, the Consumer Price Index in the US, is still above where it was before COVID, and is still above their arbitrary 2% target. And he knows that there are several things in that basket that are moving up and will be moving up and are going to make inflation worse. When he talks about the uncertainty around tariffs and what that might mean for inflation, I think that's just a sort of excuse, frankly. The other reason he's reluctant to cut rates, of course, is because Trump keeps telling him to. Mm-hmm. And so I think any normal person with any ounce of dignity, if they're constantly berated for being a moron and stupid and they need to cut rates now, the natural reaction is not to, right? So I think that's it. But if you look at what we call a dot plot, and I should ask you, are most of your listeners American or not?
No, they are. About 45%
Okay.
of readership and listenership are from the USA.
Okay, so I don't need to keep explaining all these American terms then. Okay, so the Fed's last dot plot in June, where the members write down their expectations, the average was looking for a Fed funds rate under 4% by the end of the year, or the median rather, was under 4% by the end of the year. So that's calling for more than 2 rate cuts before the end of the year. And that's the Fed members themselves. So I think we're going to see rate cuts before the end of the year, but rate cuts help the deficit and they also help the economy. But if I may, what I really think the Fed is going to do before the end of the year is reintroduce some form of quantitative easing, QE,
Mhm.
because that's how the federal government is going to sell their bonds. We're in a situation where not only has the deficit gone up, so the amount of bonds that have to be sold has gone up, but it's only just been last week that the debt ceiling was increased. And so until the debt ceiling was increased this year, when Trump came in, the cupboard was essentially bare. Yellen, on an interview on the Friday before Trump was sworn in, said that the Treasury would hit the debt ceiling on Tuesday, which I think was absolutely outrageous.
Mm.
But anyway, so basically, since Trump came in, they've been at the debt ceiling, and the only issuance that we've had this year has been when bonds have matured. That's already a pretty large amount, but when bonds mature, then they can reissue them. But there's been no new issuance. So now we have 1.6 trillion of additional bonds that have to be issued from now until the rest of the fiscal year. So we're issuing a lot more in a shorter period of time. And I don't think the demand is there. Bessent, Secretary of the Treasury, Scott Bessent, is trying to sort of cobble together with carrots and sticks and all sorts of stuff. The banks here, the big money center banks, have been told that they don't have to put so much money on, keep so much money on reserve anymore. And there's a measure in Congress from Senator Cruz that will prohibit interest being paid on reserves. So the banks are being told, you don't need to hold it with us anymore, and we're not going to pay you on it anymore. And I bet you there's some arm twisting going on for the banks to buy some treasuries. That's probably estimates that I've read would say about 250 billion. So that's a lot.
Mm.
Wells Fargo, we won't go into the whole story, but they've been absolved of their 2008 sins. And I bet you they were told, maybe you'd like to put some of that 50 billion into treasuries. So he's cobbling together and stable coins, of course. They just passed this stupidly named Genius Act. And so making it easier, the regulation on stable coins, much, much easier if they back their stable coin 100% with treasuries. So that's going to be a demand. Is it going to be this year? And the fiscal year ends September 30. How much is going to be this year is difficult to say, but you get the point I'm saying, that they are, and hats off to Bessent, sort of cobbling together all these different things. Was there a handshake deal with Britain? You got a trade deal. Maybe you want to buy some of their treasuries. I don't know. But when all's said and done, I don't pretend to be an expert on the treasury market, but when it's all said and done and you add up all these components and you make estimates for how much money will come in from stable coins this year, I mean, it could be huge next year and the year after, doesn't come close to 1.6 trillion. And we know China and Japan are sellers, not buyers.
Mm-hmm.
I don't think Brazil, after the tariffs, is going to be rushing to the US bond market. And so when you add it all up, it doesn't come close to 1.6. And so where's that going to come from? I think the Fed is going to ride to the rescue again and reintroduce QE.
I think that would make a lot of sense given how you've explained it. It might not necessarily be the right thing to do, but once you put the pieces of the puzzle together like you have, it is two and two making four rather than two and two making 44. So I think it's a case of let's see what happens. And I don't blame Powell for doing what he's doing as such. I think he's smarter than he looks, first of all. But secondly, yes, if I was saying to someone, oh, this idiot or this buffoon or this moron's not doing X, Y, and Z, I think the natural reaction for people is to, put their foot down and go, I'm not budging. And I don't blame him if that's the case.
No, absolutely. And I do agree with you, by the way. I am a big Fed critic. I don't think anyone has ever heard me say anything good about the Federal Reserve as an institution in theory, but also in practice. I mean, look, since they came in 1913, the US dollar has lost over 99% of its purchasing power. That's by the Fed's own statistics. I don't think that's a coincidence. But anyway, but I do agree with you. But let's just say I think Powell is the best that we've had probably since Volcker.
Yes, I think that's a fair sentiment. And I know that whenever I listen to Peter Schiff, he's advocating that actually rates should go up the other way. He should start hiking and not start reducing them.
Well, you know, the problem is, of course, and as you know, I should disclose, I manage Peter Schiff's gold fund. So we do have disagreements from time to time, but I try not to be too. The problem is, and Peter knows this, of course, the problem is that with everything you do, inflation goes up, inflation goes down, interests go up, interest rates go down, the dollar goes up, the dollar goes down. Whatever happens, there are beneficiaries and there are the opposite of beneficiaries. There are people that are negatively affected.
Mhm.
Interest rates is an obvious case because if interest rates move up, so savers are helped. But it restricts borrowing. So everything that happens, you have to make a judgment as to whether there's more people who benefit or more people who are negative, and who are negatively affected, and also how strong the benefits and the negative effects are. There's a lot of smart people, Peter Schiff being one of them, but there's a lot of people who think that the Fed will have difficulty cutting and shouldn't cut.
Mhm.
Certainly, if the Fed cuts before inflation is under control, that risks inflation moving up. But my own sense would be that to raise rates at this point would not only hurt the federal government in its debt issuance, but in its sorry, not in its debt issuance, in its interest payments,
Mhm.
in the interest in the debt service. But it would also hurt the economy at this point. I mean, the economy is already slowing. Retail sales on the surface look good, but if you look under the hood, you see two things. One is that more and more people are maxed out on their credit cards. So if your spending is continuing, but it's only by credit cards that you don't pay off, that clearly can't go on forever. And you see that in the patterns of spending. Discretionary spending has gone way down. Consumer durables has gone down. Consumer discretionary has gone down. Airlines have just recently started going down.
Mhm.
Airlines and hotels. And so that means people are spending more and more on essentials. So anyway, to raise rates is not going to help people who have credit card debt.
No, no, it's definitely not. And as you said, there's going to be no matter who says what or how they do it, there's always going to be your positives and your negatives. And I guess it's just about weighing out which is sometimes the lesser of two evils.
Right. Absolutely. Absolutely.
Adrian, I know we touched upon gold and then we just looked at an overview of the US there. And I know that a lot of listeners do have an active interest in gold, silver, and mining stocks as well. And you've just alluded uh, back there that you manage one of Peter Schiff's funds. So I'm not going to necessarily ask you for specific companies unless you want to divulge, but let's go into mining. Obviously, it's the potential there is absolutely incredible. So what sort of things do you look out for when you are looking at allocating resources to mining stocks, mining companies, etc.?
Well, I mean, obviously, the first thing you look at is what you think is the macro environment for the metal itself. So if we're talking gold stocks or gold and silver stocks, the first thing to look at is what your expectations of the gold and silver prices are. And you have to make some kind of assessment because the truth is, if gold and silver prices go down, there are very, very, very few companies that will hold up in that kind of environment. It's unlike grocery stores or widget manufacturers. The price of widgets can go down, but a widget manufacturer can still make money.
Hmm.
So that's the first thing to look at. And then the second thing to look at, in my mind, is just how expensive or otherwise the stocks are. And, Oscar Wilde said that everybody knows the price of everything, but the value of nothing. Or he didn't say everyone, he said a lot of people. And that's certainly true when it comes to investing. I've had so many people say to me, oh, well, the XAU's up 50% in the last year. The stocks are too expensive. And that is just such a simplistic and frankly, totally erroneous way of looking at it. So if you look at gold mining, for example, the price of gold has gone over the last 12 months, I don't have it in front of me, from 1,800 to 3,300. As the price of gold moves up almost not far from double, that means your NAV moves up dramatically, right?
Mm-hmm.
And so if the stock goes up 50%, but your NAV has gone up 70%, you're actually cheaper today than you were a year ago. Similarly, if the price of gold moves up and the margins are expanding dramatically because the costs of mining haven't gone up anywhere near as much as the price of gold in the last 3 years, well, then your cash flows are expanding. And if your cash flows are moving up faster than the price of a stock is moving up, your price to cash flow metrics are lower today than they were a year ago. And so the gold stocks today are actually cheaper. They're more undervalued today than they were a year ago. That's the thing that I really want to get people to understand, even though the gold stocks have gone up over 50%. And they're selling at very, very good valuation. So if you've got gold at close to record highs, close to record highs, and the outlook for the next year is positive, you've got margins expanding tremendously. I mean, a lot of companies have all-in sustaining costs at under 1,400, some under 1,300, and the price of gold is 3,300. These are amazing margins. They've strengthened the balance sheets so that the XAU is net cash positive right now, which is amazing in a capital-intensive industry. You expect that for miners, right? And yet, with all of that, the stocks are still undervalued. So, I think it's very clear. I will say, to use a sporting analogy, I will say that the second, third batsmen have just walked out of the crease. And for Americans who don't know what that means, it means we're very close to the beginning of this market. Because you look at, say, the GDX flows, people are still pulling money out, right? This year, it's been something like $3.3 billion flowed out of the GDX, and is still continuing in the last month. So we haven't had any sort of mania. We haven't had any kind of flood of investors into the gold stocks yet. So I think we're still very much at the beginning.
Yeah, it seems to me that it's not really on people's radar because I have a feel, and again, this is part of the joy of doing these interviews and running the channel, is to share this information, because there is potentially, if you're in the right place at the right time with the right companies, there could be some life-changing amounts of cash to be made if you're in the right place at the right time here.
In the gold stocks, absolutely. I mean, I've been talking primarily about the XAU and the GDX, the senior stocks, even the GDXJ, which calls itself the GDX Junior. They're not juniors at all, not juniors as you and I and most people understand them. And you look at some of the juniors, they are beginning very, very selectively to move. If you look at I think it's called, they need a nifty name for it. It's called the the S&P TSX Venture Metals and Mining Index. They should give it a name, right? You could come up with a good name. But if you look at that over the last 3 years, it's essentially flat, Even this year, it's gone up like 1%. But you look within the components and you see stocks that have doubled, tripled, quadrupled within that index. And so you're beginning to see movement when these juniors have good news, good results or whatever, they can move, and they move dramatically, which is what you expect but it's also different from, say, 3 years ago when any company would put out news seemed to get immediately sold because it
Mm.
reminded people they own the stock. So again, that's a sign to me that we're just at the beginning of this movement. We're just beginning to get interest come back in. And you're absolutely right. I'm not allowed to talk about performance of specific stocks, so I can't do that. But let's just say there are stocks that have just been taken over, where the returns over the last 12 months are, 500%. Nothing wrong with that. And that's just in general. Yeah.
No, that's a very good point, and I like the point that you made at the start, where if people are looking for, maybe some exposure in the sector, they need to look at the bigger macroeconomic picture and just think what's going on with everything we've discussed so far in this podcast, what's going on, what's likely to happen, and then when we get rapid inflation, what's then that likely to do to the gold price? And again, it fits like a glove, doesn't it, at the end of the day?
Right, absolutely. Well, and as you say, at the moment, gold stocks are not on most investors' radar.
Mm.
A survey by Bank of America showed almost 80% of registered investment advisors had less than 1% allocation to gold. They didn't ask who had zero, but I bet you most of the people had zero.
Mhm.
Um, it's just not on people's radar. Now, why is that? There's two main reasons. Well, one is that the macroeconomic environment until recently has simply not been conducive to gold. You've had a relatively strong economy, you've had inflation come down and reasonably under control. You've had interest rates high, certainly high in real terms as well
Mm.
as nominal terms. And until this year, you've had a strong dollar. And so that's precisely the wrong environment to be buying gold. And the people that have been buying gold have not been buying it because of what I call the traditional economic factors. They've been buying gold for other factors. We mentioned central banks, for example. They're not looking at what's the interest rate and the inflation rate in the US when they decide to diversify their assets. And so as the US economy is slowly slowing. There's increasing signs of slowing. As interest rates move down later in the year, as inflation maybe ticks up a little bit, and I'm not expecting runaway inflation, and as the dollar's oversold right now in my mind, but as the dollar falls over the longer term period, then people start to look at gold. And when the S&P stops going up month after month after month, and the leaders, you own Nvidia and Apple and Microsoft and think you're a genius. And when they stop going up month after month, people start to look for other things. But in the last 12 months, you just haven't had to look for other things, right? If you're in the
Mhm.
S&P, it's fine.
Yeah, there's a lot of opportunity coming down the road. And again, it's the joy of doing this is to be able to share information, speak, to people like yourself, Adrian, who can, share their knowledge and just have a conversation about this is what we should be looking out for because, there's a lot of opportunities. Um, I keep dotting around here. I should have spoken, maybe asked you about silver earlier on, and maybe your answer might be the same. Obviously silver, a lot of euphoria at the start of the week. It went over 39 in the futures, maybe spot as well. It's now down at about 37.50. Again, I think people can get very upset with silver because it always does the opposite of what you think. But ultimately, I think you've alluded to this already. Moving forwards in the long run, it's got a lot of potential. It's probably going to go a lot higher. It's just not going to be a straight line up, basically. What are your
No,
thoughts?
absolutely. And I'm not expecting gold. A lot of people have $50 and $100 targets on gold. I'm not expecting us to get to $100 in the next few months. I mean, we've had a really good run. I think there will be some consolidation, meaningful consolidation, before moving up again. But there's a couple of things about silver, or three things about silver, if I can say. On the one hand, when you look at the supply of silver, it's really different from the supply of gold. First of all, most silver production is byproduct silver. So it might be 8% of a zinc mine in Peru is silver. Well, the zinc miner in Peru is not going to increase his production or open a new zinc mine because the price of silver goes up. And the point I'm making is that silver production does not respond very well to changes in the price of silver, up or down, because there's just very few pure silver mines or even dominant silver mines out there. Most silver is byproduct and small amount of byproduct from base metals.
Mm-hmm.
The second thing, of course, is that there are not huge above ground stockpiles of silver. So silver has much less resistance when it's moving up in price. You just don't have an awful lot of resistance from physical selling. Now, of course, there's a price when anyone will sell their silver. You know, even the most avid silver bug would sell some of his silver, you know, if he woke up tomorrow and it was $900 an ounce. But there isn't that, unlike gold, where there are these huge above ground stockpiles, that doesn't exist for silver. And so the third thing, which is now a positive, is that, well, that's a positive, I guess, but for silver to move dramatically higher, you really need small retail investors to come in droves. You know, we know about the industrial demand, the solar panel demand, but the truth is solar panels certainly have become more efficient. So even if the projections for solar panel sales remain the same, and I'm dubious about that, frankly, but the amount of silver will probably go down, has gone down over the last couple of years, but probably will continue to go down as they become more efficient. So that doesn't really move the price of silver dramatically. What really moves the price of silver is when you start to get investors moving in and the silver ETFs start getting massive inflows. We're not really seeing that yet.
Also, to add to silver's uses, and it's a dark subject, but it's stuff that I've mentioned before, is if we are continuing to go down the hot war path, of course, a lot of warheads and so forth need a lot of silver. So again, that could be an unfortunate demand case that may have an impact moving forward. I mean, that's my opinion. I don't know if you
Sure.
agree or disagree with that.
No, that's absolutely true. But yeah, that's absolutely true. Yeah.
Adrian, we've covered gold. We've looked at silver. Obviously, mentioned a bit about the overall mining landscape as well as the US and debts and so forth. We've had a quick look at bonds. Is there anything that we haven't spoken about that you think people need to know about, or is there something you would like to add to the conversation that we've had?
Well, the one thing we haven't talked about, of course, yet is equities. And you know, there's no question that the US equity market, and in my mind, most developed equity markets, frankly, are overvalued based on their historic valuation. And when someone like me, a value investor, when I say I think the S&P is overvalued, it doesn't mean that I expect it to crash, and I certainly don't expect it to crash tomorrow morning. That's just a reflection of how much risk is in the market. You know, the more overvalued it is, the more risk there is. But of course, markets can stay overvalued. As what's that old saying? The market can remain overvalued longer than I can remain solvent. That's what the short sellers say. And so, you know, we've seen that. And what we're seeing in the US and to some degree, to a slightly lesser degree in Europe and in Britain, are sort of automatic monthly investments through pension plans and so on. So here in 401ks, you know, most 401k money is invested in the S&P index. And so as people are employed month after month after month, there are contributions just automatically moving into the S&P index. And so that can go on for a long time. I don't really expect the, I know I don't really expect the S&P to decline until the economy shows clear signs of slowing and the labor market in particular starts weakening. Because then two things happen. One is the corporate earnings either
Mhm.
decline or don't grow as much or grow less than expected. But secondly, if people aren't employed, those automatic 401 contributions start slowing. And that's when I really think we're going to start seeing the S&P change direction. Now, in the meantime, you might get to a point when NVIDIA, I mean, these the Magnificent Seven, as they're called, have already stumbled one by one. And partly that's just because the growth expectations that are built into their stock prices are just unrealistic. You know, NVIDIA simply cannot, however great a company it simply cannot grow in the next 4 years at the same pace that it's grown in the last 4 years. And so as you start to see some of these stocks stumble, then people will start to protect the profits, take money out, and look for other areas to put their money. We saw this in February that when the S&P stumbled, we had big inflows in the US into European equity funds. So
Mhm.
people looking for another place to put their money. And that could be value stocks in the US, which have lagged tremendously. Dividend paying stocks in the US have lagged tremendously. Most global markets, as you know, over the last, well, really over the last 15 years, have lagged the US. That's the longest period we've had of US outperformance against non-US or foreign markets in history. But this year, Europe has outperformed, or sorry, the foreign markets in general have outperformed the US this year to date. Only marginally, but they've outperformed. So things are beginning to shift. So I think we'll see money flowing into foreign markets, particularly into the emerging markets, which have lagged tremendously and are actually undervalued now. And we'll see money flowing into gold, silver, and other commodities. In my mind, that's what I'm expecting. I mean, the commodity complex in aggregate is basically at 100-year low relative to financial assets. I mean, that is astonishing.
Mm.
Now it moves in big waves. So you've had maybe four major waves over the last century. Commodities tend to move in long cycles. And it's been cheap before, but it's never been this cheap in the last 100 years. And those things just, you could have said the same a year ago, of course, right? Oh, this is
Mhm.
really, but these things don't go on forever. That's the point. They turn at some point.
Yeah,
And
and
you
I think
look at
that's
stocks, sorry,
yeah, no after you.
I was just going to say, look at Hong Kong stocks. There's obviously a big risk with China because Hong Kong's not really separate from China anymore, unfortunately. More's the shame. But you look at Hong Kong stocks, and they are selling at very, very low multiples. You're seeing stocks in Hong Kong, good quality companies with strong balance sheets that are trading at 3 times earnings. Not because they had an earnings spike, but the stock prices are just so low right now. You're seeing stocks that are trading at 20 or 30% of book value, really cheap. So there's a lot of value in some of these. I don't know if you'd call Hong Kong an emerging market. Let's just say smaller markets. A lot of value in the smaller markets. Singapore, I think, is a very good market to look at.
Yeah, I was going to say that helps to explain why, we've seen highs recently in the DAX over in Germany, and the FTSE 100 I think was at all new time highs at the end of last week. And again, that just goes hand in hand with what you've just explained. And the other thing I was going to point out is, again, I'll probably use this as a headline for the show, which is, gold stocks being cheaper than they were 12 months ago. That seems almost counterproductive to say, but again, with all the factors that you've explained, they are cheaper than they were 12 months ago. So
Oh,
never look a
on a
gift horse in the
fundamental
mouth.
basis, yeah.
Mm,
Yeah. And you look at some of them, I mean, like Agnico Eagle, which is the third largest gold mining company. You look at their price to cash flow over their entire history,
mhm.
and it's selling basically in this lowest quarter percent, the lowest quartile of its price to cash flow in its entire history. You look at Barrick, that's selling basically in its lowest decile price to NAV. Now, Barrick has issues. You know, it's mining Mali's been confiscated, and its next
Hmm.
big project is in Pakistan. But that the political risk is reflected in the net asset value, right? I mean, an analyst who makes a net asset value calculation adjusts for political risk. Barrick is trading at its lowest decile price to net asset in its entire history. And so normally when the price of a product, when the price of gold goes up, you see multiple expansion. And we just haven't seen that.
Certainly a lot to watch out for, I think, moving forward. So I think there's going to be a lot to talk about in the next, 5 or 10 years, to say the least. Adrian, I think it's been a wonderful conversation. I think there's a lot for people to take away. In a nutshell, if people are looking at gold and silver and then potentially mining stocks as well, the key takeaway would be that they need to think about what they think is going to happen to the prices moving forward, given all of the other geopolitical and financial things that we've discussed. And of course, we've deep dived a bit into the USA and what Powell should or shouldn't do, and really the fact that it sounds like they're almost damned if they do, damned if they don't.
Absolutely.
I've got the I've got in front of me here adrianday.com's the best way to contact you if people want to find out more about you and your
Yeah.
services. I know we've both mentioned Peter Schiff as well, but I've got adrianday.com. Is there any other ways that people can connect if they want to?
Well, they can, I mean, the website's obviously a good place to go, or they can email us at assetmanagement@adrianday.com.
Fantastic. I will put links to that into the show notes that come with this video. And again, a massive thank you for your time. I've learned a lot and look forward to speaking again in 2026.
Yeah, no, absolutely. Really appreciate it. This was a good interview. I enjoyed it.